afternoon and welcome to the ACT webinar, How Safe is Your Bank? The Counterparty Risk Challenge. This is being brought to you by the ACT with the support and sponsorship of S&P Capital IQ. S&P Capital IQ is a leading provider of real-time data, research and analytics and was formed in late 2010, combining the non-ratings assets of Standard & Poor's and Capital IQ's financial information and analytics. I should emphasize that S&P Capital IQ is a separate and distinct business from Standard & Poor's rating services, with suitable Chinese walls between them. But today, we'll hear presentations from both firms. Our speakers are Michelle Brennan for S&P Rating Services, whom we'll hear from first, followed by Andrew Lecoq and Maria Shevchenko from S&P Capital IQ. We've got 45 minutes for the whole webinar, and this will include about 15 minutes at the end for questions. If you look at the right-hand side of your screen, there's a box there where you can type in your questions. So do send these in, including your email address, and send them in during the presentations rather than waiting until the last moment. Also on that page, if you click on the tab for Documents and then Survey, you'll see there's a link to a short follow-up survey we're doing. We're seeking feedback on the webinar, plus a snapshot of some of your attitudes to credit risk. We all know that counterparty credit risk has been, and still is, very high on the agenda for companies. But perhaps many of us aren't really resourced to do a thorough job on this. Instead, we rely on what might be called outsourced providers. So in this webinar, we'll explore what you can sensibly do in-house and what you'll seek from outside, and how do those outside providers go about their credit assessments. So to get started, we'll start with Michelle Brennan to talk about the framework that the rating side uses to look at banks.
Thank you very much, Martin. As Martin said, I'm Michelle Brennan, and my role at Standard & Poor's is to be part of the criteria function that develops the methodologies that we use to assign ratings to banks. So today I'm going to bring you on a whistle-stop tour through how we assign ratings, and also talk about what the key factors are that drive rating changes currently for banks in Europe. Looking at the next slide here, on the agenda today, I'm going to bring you through the bank rating methodology framework. I'm going to focus quite a lot on what we call the bank sovereign feedback loops. In other words, how things that are happening with, let's say, sovereigns or macroeconomic trends affect and interact with the banking system to drive changes in ratings. And I'll talk you through how our criteria captures that, and also show you some of the current data or current views around that from Standard & Poor's. I'll finish off by talking through some other factors that are also relevant for ratings, such as capital, funding, and changes in regulation. But because we're looking today very much at Western Europe, there's a big focus on this sovereign and macroeconomic interaction. Maybe before we kick off, I'll just start off by saying, well, what is a rating? What isn't a rating? Well, first of all, a rating from Standard & Poor's is an opinion about the relative likelihood that an investor will get their money back in full, in completeness, and also on time. So it's looking at the relative likelihood of timely and full payment of the obligation. What we don't give in a rating is some sort of loss given default or magnitude of loss estimate. And also, of course, ratings aren't recommendations in terms of whether a particular investment would make sense or be appropriate for a particular investor. However, we do think there's some good information content, and I'm going to talk you through the way the criteria looks to give you good information content about how we come up with our opinion on the relative likelihood of incomplete or untimely payment, and also how you can use that information and some of the component or constituent parts of that information in order to also help your own credit analysis. Now here on this slide, it looks pretty busy, but pretty much this slide is summing up over 70,000 words of criteria around banks and how we assign ratings to banks and different types of transactions. So this slide is busy, but has a lot of information in it. In November 2011, we issued new criteria for rating banks, and that was after a lengthy consultation process where we updated the criteria to improve the transparency of the criteria and also build on some of the lessons that we learned from the financial crisis. And this slide here shows the general construct of our methodology. And one of the big changes is that we start over there on the left-hand side of the page in that greyish column, which is headed BICRA methodology. Now, what on earth do we mean by that? In our assessments, we have a BICRA approach, which means banking, industry, country, risk assessment, where we look at each of the banking jurisdictions where we have ratings, and we assign a score for economic risk. You'll see that in the first grey rectangle on the left, and also industry risk scores. And they're very, very important because those scores build in to give us an anchor or an assessment of where a typical rating would be for a bank operating in a particular type of market. So with that economic risk score, we're looking at the structure of the economy within a particular jurisdiction and how that creates risks and opportunities for banks operating in that country. In the industry risk score, we're looking at issues to do with the structure of the financial services industry, which includes topics such as the funding structure and the depth of the funding market and domestic debt markets in that country, and also questions such as the institutional framework and the general level and type of competition that you'll see in that market. So we put a lot of store in this BICRA methodology because we think that in order to assess the risks that a particular bank faces, you have to start off by thinking about the neighbourhood within which that bank is located. What industry are they in? What markets are they operating in? And what risks get created by that? Because sometimes, no matter how savvy, no matter how risk-averse, no matter how careful the management team of a specific bank may be, there will be certain risks driven at the macroeconomic level or driven because of regulatory issues or maybe because of other political risks that may swell and outweigh some of the individual efforts that a bank may make. So our criteria has this big balance between the macro factors on the left-hand side, and then as we move across the page, you'll see the anchor, which will give us the typical outcome based on the environment within which the bank operates. And it's only then that we start adjusting the outcome from that anchor to look at the very, very specific risks associated with that particular bank. So, for example, let's think of a bank that's located in Greece. Given the systemic issues in Greece at the moment, clearly the anchor that will be derived for a bank operating in Greece will be quite low, and there will be limits in terms of what an actual bank operating in Greece can currently do in terms of being able to really strengthen its creditworthiness. It's not powerless, there are things it can do, but there are some big obstacles in terms of it being able to achieve certain high levels of creditworthiness because of that. So the bank-specific factors that you'll see there, we use those to adjust either up or down from the anchor assessment for a particular operation. For each bank, we derive an anchor based on the weighted nature of the markets within it operates, so a weighted economic risk score and the industry risk score. So let's say for a bank that produces an anchor, or an expected outcome of everything else was pretty much equal of, let's say, triple B, we would then carry out our assessments of the business position, capital and earnings, and so on for that institution, and use that to build up what we call the SACP, or the standalone credit profile. Now, I'll just talk a bit about capital before I come back and talk about what the SACP is, because you'll see here that one of the building blocks in terms of our bank-specific analysis is very, very much to look at capital assessments for an institution. But we do not use regulatory capital measures in order to assess a bank's capitalization. We have our own risk-adjusted capital framework where we look to assign our own risk ratings to the exposures of an institution in order to address some of what we see as some inconsistencies with current Basel measures current regulatory measures, and also where we assign a common definition of what is capital to the bank as well. So we're looking to calculate a more risk-reflective measure of capital and we think a more consistent measure of capital for banks. So the SACP is the standalone credit profile, and that's important because that's thinking about what the rating would be if there was no support. We then need to consider whether it's possible that there may be support for that bank, maybe from another member of the group. It may have a parent bank or a parent operation that is stronger and can support it, or else potentially from the government. And we will publish in all our reports what the SACP is and whether there is any support, exactly what that support is, that may or may not pull up to have an ICR or a rating that is higher. At the bottom of the page, you may see that hybrid debt issues are rated with reference to the SACP, and that senior unsecured ratings, so bond ratings, are rated with reference to the ICR. So that means it's possible that there may be government support in a senior bond, but not in a hybrid. And again, so that means it's very important as an investor to be very, very aware of exactly where a bond may lie within the structure of the balance sheet. Now, moving on to the next slide, you'll see what we currently see as the 5 key risks for European banks. Now, these should not be very, very surprising given the depth of some of the challenges facing the European banking sector. But number 1 is weakening sovereign creditworthiness. Number 2 is the threat of economic recession. We have funding constraints. Some longer-term issues are those around the transition to more stringent regulatory requirements and also the changing nature of government support. Why does weakening sovereign creditworthiness be important? Well, banks have direct and indirect exposures to the sovereign debt and also to issues that arrive in the broader macroeconomy. The threat of economic recession is also important because many banks, as they emerge from the financial crisis of recent years, are looking to strengthen their balance sheets, strengthen their reserves, and to improve their funding profiles. And a moribund or slow economy makes it more and more difficult to achieve quickly some of those improvements in the in the financial profile of an institution. Looking here at slide number 5, you'll see that 5 years in from the start of the financial crisis, we still see quite significant economic risks for banks, particularly with the Eurozone. We can't generalize, not all banks are the same, not all countries within the Eurozone are the same, but many banks are still in restructuring mode, and there are a range of banks in Western Europe that are relying on government and central bank support in order to maintain their ability to service their debt or to maintain their ability to carry on the wider level of activities. And you'll see here that we give some details around some of the main risks that we see. And the main risks very much come around from the nature of the resolution of the current Eurozone crisis, the direction of the US economy, and as well what we see is a limited, but still it's there, the possibility of a hard landing in China, which we would define of being a situation where real GDP growth would go below 5%. So we talked about how we can't generalize any particular country, but here on slide 6 we show a mix of where our current BICRA scores are. And remember, they act as a big backdrop in terms of where a rating might come out for a bank that operates in those markets. So we think that this is very useful as a backdrop to starting your credit assessment of a particular counterparty. And the bottom left-hand corner shows you the strongest institutions. Those at the top right-hand corner are those countries where we see the risks or the challenges to being a bank operating in those markets to be the highest. So I think we move right all the way up there in the top right-hand corner to Belarus. As you come in a little bit, you'll still see countries such as Greece coming in. You'll see Ireland coming in, along with some of the other peripheral Eurozone countries. But you'll notice that there are some quite big differences in our perceived and expected risks for these markets across Europe. So the 3 main sources of economic risk. In the Eurozone, the biggest point that maybe is important to play on for you is that our base case scenario is very much still that the Eurozone will remain intact, given what we still see as considerable political will towards that. However, we do see a 1 in 3 chance that Greece may leave the monetary union, and that is something that we take account of in terms of our ratings on both Greek banks and also the approach towards other European operations. The expectations that we publish here in this page are published and available publicly on standardandpoors.com. And another important issue to look at is that we are assigning a 20 to 25% possibility of the US economy going back into recession over the next 12 months, and also that we see a 15% chance of a hard landing in China. So you'll see three quite distinct but potentially risky scenarios that we see as casting overall backdrops for all banks operating in markets that would be affected to those global trends. Now, remember we mentioned that we see quite a wide range of situations in Western Europe, and the economic risk scores that we assign to countries in Western Europe indicates this very, very well. This is showing the current scores for economic risk score, coming from those at the top of the page, such as Finland and Germany, which we score as a 1. So the economies are the most attractive to be banks in at this moment. Moving down to Greece, that's at 10, and then you'll see Portugal, Lithuania, Latvia, and so on coming in at 7. You'll notice that France is there sticking out at 3, and that's to highlight that we changed the French economic risk score just last week from a 2 to a 3 to highlight some of the emerging issues around potential stagnation or more limited growth prospects and the effect that's going to have for banks in that market, which has fed through to some rating actions. We're also focusing a lot on funding pressures, and while this slide is still a macro level slide that shows some of the reliance on net borrowing from the European Central Bank, we also look at obviously micro or bank specific level funding data. But what's been very, very important in Europe in recent months is that the systemic trends and systemic shifts of investors from looking to extend lines to banks in certain countries has created situations where in some of the peripheral markets the banks have become particularly reliant on central bank funding. That reduction in flexibility around their funding models, that reduced public access is leading to tensions in terms of maintaining existing business models, and also, of course, preventing some banks from being able to prepare as quickly as may have been ideal for the transition to a new regulatory approach towards liquidity and funding under Basel III. On the last slide here, I'm going to look at one of the other big factors that's currently driving rating changes, which is the role of government support. We do still have government support in a range of bank ratings across Western Europe. And that is because, although there are many public pronouncements about how governments want to reduce the amount of taxpayer support to the banking sector in the future, we still see in the current situation significant levels of support being provided to the banking system, particularly through the more accommodating funding and positions being provided by the European Central Bank, but also other measures as well being taken by governments across Europe. So we still have support built into ratings for systemically important banks in Western Europe, in countries that we classify as either supportive or highly supportive. As a user of our ratings, you can identify all the situations where that support is built in and identify how great our assumptions are. However, we do flag that there's a tension between the provision of that support today and the longer-term trend, which is towards the introduction of legislation, such as the Dodd-Frank regimes in the US, and also the potential crisis management directive in the EU, which will look to reduce the likelihood of support and which could lead through to negative rating actions in the absence of offsetting positive developments from a bank itself. So to finish off, here's a plug for some of our research, which is that we publish our research on every single bank that we have a rating on. And that provides not just the rating, so in this situation here, for Royal Bank of Scotland, you'll see that the rating is a single A rating with a stable outlook, but also we publish the components of that rating. And why that's important is that you as a user can identify the unsupported assessment, the SACP, and also identify the individual scores that come through for capital, for funding, and for business position and so on, and use that to deconstruct the rating in various ways. So I will remind you that all of our rating reports are available on our global credit portal, but our press releases and our criteria articles are all publicly available for free on standardandpoors.com. I'm going to pass on over to Andrew now, and who's going to talk about some of the capital IQ issues.
All right. Thank you, Michelle. So My name is Andrew Lecoq. I'm the Associate Director in EMEA for Market Development at S&P Capital IQ. And today, I'm going to be walking you through the framework for the analysis that we used, and that Maria will be walking you through here shortly. What's really important over the last few years, we've seen a shift in counterparty risk management, where a number of companies are asking their credit risk teams to analyze a broader swath of counterparties, as well as asking them to look into companies where it can be very challenging to find accurate and timely information on those particular counterparties, especially, for example, if those happen to be private counterparties. This holds true as well with the banking systems and banking counterparties, where we've seen a number of organizations move to diversify the number of banks that they do business with across a number of geographies. So the one really potentially shocking percentage here is that the rated universe is rather small when you think about the rated organizations within the totality of banks or non-financial corporations that operate. And this just highlights that as you continue to expand your counterparties within the banking sector, you're going to occasionally run into situations where you might have a limited number of rated banks or even strictly unrated banks. So to conduct the analysis today, we started with an assessment of the individual banking systems where you operate, and then we moved into accounting for the risk of particular, certain concentrations of the risk that you might have. Then we moved to conducting an analysis of the individual counterparties, identifying trends among both rated and non-rated banks within a particular geography. And then finally, we continue to look at how you can monitor the banks or particular countries where you operate in order to continue to be aware of different developments that occur within those geographic markets. And of course, as I mentioned, timely and accurate data is an absolute must when conducting this type of analysis. So step one is to analyze the banking system. And the key idea here is really that multiple metrics are always better than one single metric. You'll notice that a number of sovereign ratings in some of the countries might differ from the BICRA score. And usually that is a sign of either the banking system being stronger than the sovereign or vice versa. You'll want to make sure that as you're looking at different metrics, you also think about particular concentrations, and this might require a little bit of thinking outside of the box and looking at what are the collection of concentrations of risk that you have within the portfolio. And the example that we've highlighted here is Slovenia, where you see there's a sovereign rating that is higher than its BICRA, indicating that the banking system might be a little bit riskier than the debt of the sovereign, reinforcing the idea that you really want to think about a number of metrics in your analysis. And at the bottom on the right, you'll see that we've taken the four geographies where we have the lowest BICRA score, and we've compiled them together. And you notice that there's actually a 21% exposure among the riskiest organizations or the riskiest geographies in your portfolio, which is something that you might not individually look at any one country and see a particular risk, but when you add them together, you notice that there really should be a red flag that comes up. So step two is to broaden the analysis, and this is for both rated and unrated organizations. As you can see with the examples of France and Italy, there are oftentimes many, many more unrated organizations than there are actual rated entities. So being able to identify, what are particular trends or what are different developments going on with both unrated and rating banks is incredibly important. So the one piece of feedback that we've received from a number of our clients as they've done trend analysis is to really make sure that they're looking at the metrics that have historically predicted how the credit health of particular counterparties. So this might be a financial metric, but it could also be larger systemic or macroeconomic events that could potentially impact the health of an organization. And lastly, when we get to monitoring, the evolution and the sophistication of monitoring your particular counterparties is certainly spread out along the spectrum. And the more you can use market data and market-derived signals, the more you can anticipate potential risks that occur within your portfolio. So it might be something like CDS spreads or a more sophisticated composite metric, such as a market-derived signal. As we've discussed, it's important to do this both for individual entities, whether those be banks or other companies, as well as for the banking sector, the geography where you're actually operating. And you can see from these two examples that on both of these situations, you can actually use market-derived signals to foreshadow events that might be occurring within a particular sector or a counterparty. So now I'm going to go ahead and hand over to Maria to walk you through the analysis.
Thank you, Andrew. Let me just move the slide here. So my name is Maria Shevchenko. I'm a director at S&P Capital IQ, and I oversee financial content and analytics. And as Andrew has taken you through the framework that we had in place, my goal over here is going to be to take you through a practical application of such. And in doing so, we actually looked at three particular countries, being Italy, France, and UK, and I'm going to just take you through this case study now. So first step, as Andrew introduced, was to assess the banking system risk in general. For that, I used the BICRA rating, which was also mentioned by Michelle, and it stands for Banking Industry Country Risk Assessment Rating, provided by Standard & Poor's. It allows to evaluate, assess, and compare banking industry across the globe, and serves as a starting point for bank rating in a particular country. As you've seen from Michelle's slides, the BICRA score ranges between 1 and 10, and we actually cover, as per my knowledge, 87 countries. So over here, I looked at the three countries in question, France, UK, and Italy, and I actually discovered that my screenshot here is a bit dated, considering that the ratings agency have updated, I believe, the economic risk of France to a level of 3. Industry risk, I think, still remain the same, hopefully giving the same overall BICRA group. And also, as you've seen from Michelle's slides, with the BICRA rating score, you get the strengths and weaknesses, as well as a more broader analysis. And over here, you can see that for French economy, we consider it to be a wealthy, diversified, and a resilient one, with strong creditworthiness for the households and relatively stable banking industry. On the other hand, though, it faces high tax burden, and its next external debt in comparison to its immediate peers is on the higher end. UK here, in terms of BICRA rating, rates far higher than France on economic as well as industry risk, but gives an overall BICRA group rating of 3. Italy, out of those three companies, has the highest risk level of 4, and this is, as you can see from an extract from press releases, basically due to facing a deeper and more prolonged recession than was originally anticipated by the analysts. Now, moving on to step number 2, where we are to look into individual counterparties within the specific banking sectors. And again, we're talking here about Italy, France, and UK. I started with Italy, where its banking system is highly fragmented, with more than 750 financial institutions, per my awareness, out of which, and this is also, as Andrew mentioned, we only have 21 rated banks, so a very small subsample. I then used fundamental data from S&P Capital IQ and inputted it into a credit model, which allowed me to come up with a credit score for an additional universe of 58 unrated banks. Now, while here, I would also like to mention that if you guys have access to some proprietary information, say financial indicators, I don't know, accounts from the specific banks that are your counterparties, the credit model obviously allows you to use this information to come up with an even higher universe, because we at S&P Capital IQ are only privy to public information, and thus we will only be limited to the 79 entities that we come up with here with Italy. So once I plotted the results, it was rather interesting to see that in Italy, unrated banks looked very good or slightly better in comparison to their rated entities. And one example that came out of that analysis was Banco di Sardegna, which is a publicly traded bank. It's a fairly small one, has around 370 million euros of market capitalization. It's based in Cagliari, founded in around 1940s, offers universal services from cards, loans, deposits, etc. Has had tough times in 2009 and 10, just as other banks, but in 2011 has been bouncing back, giving loan growth, and that was a gross figure of almost 9%, and also over the last years been selling its stakes in non-strategic entities to increase its profitability. Now, let's move on to the French and UK examples. Here we actually see, again, a very different slide. In the French example, I discovered that unrated banks scored below the rated universe, whereas in UK example, if you can see, the distribution is extremely similar. Now let's move on to the third step out of the fourth, so hopefully not too much to go. And here we analyze the trends. Now in this particular example, I did not have any forward-looking data for Italy, France, and United Kingdom, but I wanted to highlight that it is very important to look at trends and volatility. And for that reason, I thought that maybe the best way to showcase the importance of such is to use the Eastern European example. So again, what I did is I looked at the fundamental data from S&P Capital IQ, entered it into the credit model, and looked at the trends over the 5 years across several of Eastern European countries, which you can see plotted here. And it looks very interesting. For example, on the top graph, you see that Lithuania has gone through a significant change, and same, in the bottom graph, you'll see that Latvia and Estonia, having had some tough times during the global financial crisis, with their austerity measures, managed to improve that situation slightly. And now moving on to the last slide, which discusses the monitoring. I again, just as Michelle and Andrew showcasted already, used the credit rating of an entity, which is basically a long-term view of the bank's creditworthiness, and I coupled it with a market-derived signal, which allows or factors in the short-term volatility. And over here you see, again, I plotted two different examples, one being Barclays Bank, where you see its long-term credit rating hovers at around A+, but the market-derived signal for a prolonged time now has been in the range of A-, BBB+. Bank of Scotland, on the other hand, and I think Michelle also mentioned this example before, has the opposite situation where the long-term rating is around A, but market-derived signal hovers actually above the level. So again, this could be a view or an option for you to monitor it on a proactive basis, be it a country or be it a bank, and just to allow you to limit your exposure to something that might perhaps be too risky. So this slide is basically a very brief overview of our recent S&P Capital IQ history, and it's just to showcase that we merged two companies, Standard & Poor's with their credit expertise and Capital IQ with their fundamental, market data and analytical tools. And it's actually due to this merger or this union that I was able to implement the framework that Andrew discussed earlier through just one solution. So it kind of saved me a little bit of time. And with that, I would like to conclude because I know we're running out of time. And over here, you'll find our contact details for Andrew and myself, just in case you have any questions that perhaps you won't get a chance to ask now, or maybe will pop into your mind later on, or there's any information that you would like to discuss or ask us about, please do not hesitate to reach out, and now I'll open the floor for questions. Thank you.
Good. Thank you very much, Maria. Before we'll go on to questions now. One of the questions that has been coming through is about the slides. They will be available on the ATT website shortly as a PDF. Now, turning to the questions we've got coming in, the first one here, which is very much looking at the practical implications from the company end. Companies tend to set limits for their counterparties with different limits depending on the credit standing of the bank. Should those limits also vary with the maturity of the exposure? And if so, is there any rule of thumb that you can use to adjust for maturity? I don't know, is that one for you, Andrew?
Yeah, sure, Martin. I'll go ahead and take that. So I think that, of course, it's sometimes hard to give a generalized rule of thumb, but there's certainly room within an overall portfolio to diversify the risk of each particular entity. So I think we would look at it, and what we've seen from clients is that in the shorter term, there tends to be maybe a little more leeway or a higher risk tolerance within the portfolio. But of course, you want to make sure that as an organization you have an overall risk tolerance, and that the portfolio, both long and short term, adjusts appropriately and averages out on the whole for the portfolio. But there is certainly some room to take on maybe some additional risk in the shorter term, as long as that's appropriately weighted over the long term portfolio.
Okay. Yeah. Thank you for that. We'll move on to another question. This one's from Andrew Burgess, and just slightly paraphrasing it. If starting with the BICRA as the sort of anchor for the bank ratings, does this mean that if the US government is downgraded, there'll be an automatic downgrade of all US banks? I think, is that one perhaps targeted at Michelle?
I think that's one for me. Thank you very much. Okay, so the question is about what happens. Does a sovereign rating change lead to a BICRA change, and then does that lead to an automatic rating change for banks? A change in the sovereign rating can lead to a BICRA change. It doesn't automatically do so. I would say that the lower down the rating scale you go, and the greater the depth of a rating change, particularly for multiple notch ones, then it's more likely that there will be a BICRA change. BICRA changes don't automatically happen, though, at all points where there's a sovereign rating change. And that's because while some of the elements that go into the sovereign rating also go into our economic risk score for the BICRA, they're not entirely completely correlated. And one example there might be to think of the UK. The UK has a AAA sovereign rating, but the economic risk score that we have for our BICRA analysis is a group 4, which is still pretty good, but it's not exactly a 1 or a 2, okay? And despite the fact that it's a AAA for the sovereign. So if, for example, the US were to get downgraded, okay, and I'm not a sovereign analyst, so I'm not giving any prediction on that, then it is possible that there could be a BICRA change. If there were to be a BICRA change or an economic risk change, score change, it could lead to a rating change, but would not automatically do so. It would do so for even if the anchor changes for a bank, the rating would not necessarily change if it was felt that that bank has a profile that offset or allows it to weather the change in the macro situation. But Andrew's question is right in that there are often related changes, but we should not think of it as being automatic.
Good. Thank you for that. Moving on to a further question. What do you consider to be the greatest single risk to the integrity of the global banking system at the present time? Well, there could be an awful lot of risks, but I wonder if our presenters would like to home in on just perhaps one or two.
Okay. Maybe I'll kick off on that. Well, it's a pretty big question, and there's different ways of interpreting the integrity of the system. Maybe if we talk about the things that we see as the biggest challenges in terms of the ratings to banks at the moment, I'll paraphrase into two areas. Number one, dealing with the overhang from the banking crisis, and the over-leverage that still exists in a range of markets globally, which of course is interlinked with the sovereign crisis, and which is creating fundamental requirements to revisit business models and the structure of some of the banking sectors in a range of countries, and of course against the backdrop of making economic growth and the ability to pull activity out more difficult. The second issue maybe I'll raise is one around moral hazard. A moral hazard built up in the banking sector because of the expectation for many participants that government support would be forthcoming in the event of problems at certain systemically important banks. And what we're seeing at the moment is a situation where the governments are looking to address that moral hazard through forms of regulation. But regulation by itself is probably not enough to really encourage or get rid of moral hazard from the banking sector. We'll also need to see improvements, as is beginning to happen, but improvements in terms of risk management and governance. And those real improvements in terms of risk management will be encouraged by more effective regulation, but probably also by more effective supervision of banks. Both external supervision by banking regulators, but also the oversight that comes from the shareholders, from the investor community, and of course from the boards of directors as well. Okay,
I think in the interest of moving on to a variety of questions, perhaps we can move on to another one. Actually, this one, or the theme, has come in from several people around CDS, and it's asking, if CDS spreads convey valuable information, what exactly is the Treasurer looking for, and how does he disentangle the noise from the real credit message? So I guess how do you use, or how would a Treasurer use CDS spreads? What message do they give? Any thoughts on that?
I'll try to answer this, and this is Maria, and it's actually a very interesting question, but there's couple of points of thought that I would also like to raise. So, for example, I would not suggest looking at CDS on its own. I would obviously look at it in parallel to other metrics, be it ratings, be it fundamentals, be it market data, because CDS spreads on their own might not tell the whole picture. When talking about CDS in particular, then it also depends how you look at it. Do you look at volatility with regards to a specific bank and say 1, 2, 3% increase or decrease in the CDS? Is that a tremendous step for that particular bank, or is it a fairly small one in comparison to its immediate peers? So it's in my view more to be looked holistically together at various aspects to make sure where the particular entity or the counterparty stands on the CDS front, and where does it stand in comparison to other banks that are similar.
Okay, that's helpful. Thanks very much. I think, looking at the clock, we need to start thinking about winding up. If any of our audience have further questions, as the presenter said, their details are there, or you can forward them questions through to the ACT and we'll pass them on. Before we finally close, can I remind you that the ACT has published a couple of briefing notes itself, which are available on our website. One was on investing liquid funds, but there was another one of this pair called Bank Counterparty Credit Assessments for Companies. So if you look on our website and just type in investing liquid funds into the search box, you'll find those. I hope everyone's found the webinar helpful. To round off, can I remind you to take a moment to have a look at the survey that I mentioned earlier, which you can find through the little tab called Documents. And finally, thank you to all our presenters and to S&P Capital IQ for your sponsorship. Thank you very much.